Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights, and welcome to a brand new week ahead. I hope that you all have a great and restful weekend. Very good morning, I'm Kelvin here. Welcome to today's Daily Dose. Today will be Monday, the 16th of September 2024. So before we jump straight into today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. As well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, before we jump straight into the daily dose of market insights for today's short-term intraday technical outlook, and as well as what are the longer term, or I would say medium term or multi-week time horizon intermarket dynamics, let's have a quick recap what has taken shape on last Friday and on the weekend in terms of economic data release and its impact on the various broad-based cross asset classes. So let's start with last Friday. So on last Friday, we do have a important US data release in terms of economic data, which is this University of Michigan, pardon me, consumer sentiment, and the university released its preliminary survey for the month of September. That means i.e. for the month of this month. So they tend to release 2 weeks before the end of a particular month. So this is more of a flash reading. So why consumer sentiment is important? Because it has a direct correlation with US consumer spending. And why US consumer spending is important? Because consumer spending forms a key services related proxy in terms of economic growth driver in the US. So we know that US itself, close to 2/3 of the economic growth in US is driven by the services industry rather than the manufacturing industry. And we know that right now there is actually a risk of US slipping into a recession ahead of the Fed kicking off its interest rate cut cycle, which is pretty much widely expected on this Wednesday. We'll touch more about that in our daily dose as we head into this week, FOMC week, which is on Wednesday, US time, Thursday, early 2 a.m. Singapore time. We'll talk about more about that tomorrow and the day after. So now straight into this consumer confidence preliminary data. So it came in slightly better than expected at 69. Market is expecting 68, and also above 67.9 print that was printed in August. So if you look at the consumer sentiment trend, based on the trend, okay, it has increased for the 2 consecutive months. All right, so previously it continued to kind of decelerate in May, June, July at 6.4, and right now at September, it actually increased by 2 consecutive months, okay, inch higher. So it did indicate that the US consumer sentiment has started to improve. But what interesting over here in the market's pricing at this juncture, it seems to me us that market is still looking for a kind of recessionary scenario in the US that has already been kickstarted ahead of this Wednesday FOMC meeting. And how do we read that? Is by looking at the CME Fed Watch tool. All right. So for those who just joined us for the very first time, this CME Fed Watch tool, so you can just Google CME Fed Watch tool, it will bring you to this particular table where CME help us to tabulate the expectation of the Fed cut or hike by how many basis points taken from the 30-day Fed funds futures market. All right, so this particular table here, the current one, we know that the current rate of the Fed funds rate is at 5.25%, at 5.5%, and what the futures market is pricing, the Fed funds future is pricing as compared by this CME Fed Watch tool, we see an increase of odds of 58% on last Friday, or on right now. In fact, we are speaking right because the current is actually delayed by 1 to 2 hours, but it's based on the current pricing right now as we are speaking in Asia trading session. Is now up at 58%. So if you look at the trend over here, 5.75% to 5%. So market is expecting to cut by 50 basis points to bring it down to this 4.75% and 5% in the Fed funds rate. So previously on Friday, upon the release of the consumer confidence data, the probability jumped to 50%. It was from a week ago at 30%, a month ago 35%. That means in the past 1 week and the past 1 month, market is expecting not so much of a jumbo cut of 50 basis point cut in the Fed funds rate. But after the release of the consumer confidence data, which is better than expected, but market still looking for a jumbo cut of 50 basis point, where the probability jumped by 50%. And as we are speaking right now, the probability jumped up by 58%. So we see a incremental increase in odds of a 50 basis point cut, and this odds has now go past the 50% level. All right, so indicating that market are now looking for a much more dovish stance by the Fed as compared to a week ago and a month ago. That means it tends to imply that it seems to us that market is looking for a Fed that is getting a bit of panicky, where they may be late in their interest rate cut cycle, and perhaps there is also a rising chance that the US may really slip into a recession. And what's interesting over here is that if we were to look at the aggregated probability over here, this is the aggregated probability. So aggregated probability is actually looking into account of across the calendar down the line over here. So let's say, for example, it gives us 1 year of data, that means 12 months. Because now we are heading to the 18th of September, then they project it all the way down to 17th of September next year, 2024. So if we were to look at this instant over here, by September 17th of September 2025, pardon me, 2025, 95% chance the Fed funds rate will be at 2.75% 3%. That means, i.e., you're looking at 12 months from today, the Fed is expected to cut by at least 2.5%. Very simple. How do I get that? You get the current Fed funds rate, which is at 5.25%, minus off 2.75%. So this gives you the expected cut of around 2.5%. Right, so given this very aggressive pricing in by the CME Fed Watch 2 based on data from this 30-day Fed funds futures, that means, i.e., the Fed now got to deliver as what market is expecting. Right, so that is actually the onus now is on the Fed to actually look at to actually meet this potential expectation as being priced by the CME Fed Watch 2, which is at this level right now. But don't forget, this particular we call it level will change. It's dynamic, it's not static, based on incoming related news flow and data. And do not forget, yes, tomorrow we do have another important data in US pertaining to US growth related one as well, which is retail sales. So that will come in 1 day before the US Federal Reserve FOMC meeting. So that dynamics could change as well. But based on the current dynamics, this market pricing over here is rather ultra dovish, based on the way the market is pricing in the expected Fed funds cut. So if you look at the closer down the calendar, so this one I explained to you earlier on, market is expecting 50 basis point cut in this coming Wednesday. Then on the 7th of November, it reduced down to 25 basis point cut. Then thereafter, another jumbo cut of 50%, which is 73% odds, to bring down the Fed funds rate to 4% to 4.25%. So that is being penciled in on the 12th of 18th of September 2024 FOMC meeting. So all in all, before 2024 ends, market now is expecting 1.25% cut in the Fed funds rate. Okay, so a rather aggressive pricing instead of a even number of 25 basis point cut each. Market now is looking for 250 basis point cut each to come, 50 basis point cut each to come in this Wednesday. Then thereafter, another 50 basis point cut on the 18th of December 2024. All right. And what's interesting over here is, despite this kind of recessionary like pricing as being implied by the interest rate futures contract, the US stock market continues to struck off this recessionary risk, we call it odds, that is being priced into the market by the CME Fed Watch 2 pricing, and continues to take stock prices higher on last Friday. So I could see across the board almost all the S&P 500 sector or S&P 500 component stock, mostly of them are in the green. And if you look at the sector performance wise in terms of last Friday, we do see the defensive sector that is outperforming utilities by 1.55% point. That means a bit of defensive play. There's been rotation into the defensive sector, but that's right, on technology sector and the communication service sector also join in the band of outperforming as well the sector. So communication services sector is considered as an aggressive sector. Why? Because communication service sector, we do have two mega cap technology stock that inside this particular sector, which is Meta and Google. All right, then for that, technology will be your Microsoft, okay, as Nvidia, which is positive 0.4%. All right, so net overall, if you were to look at the across the board, we do see very rosy performance. Even the Russell 2000 outperformed on last Friday, given this rotation play that is taking shape away from the mega cap stocks, going back into the Dow Jones Industrial and the Russell 2000 cycle. Those are kind of a cyclical and small cap factor. Small cap heavily weighted indices that outperform the Nasdaq 100 and the S&P 500, which is pretty much more heavily weighted on the mega cap stocks. So the Dow Jones Industrial Average added 0.7% on last Friday. The top performer was a Russell 2000, up 2.5%. Nasdaq underperformed, but with a positive gain of 0.47%, and the S&P also performed with a positive gain of 0.5%. So despite the fact that the pricing on the short-term interest rate futures contract of the 30 days Fed Fund futures indicating a kind of a recessionary like scenario, but the stock market continues to ignore this possibility. By last Friday, stellar performance in the lagging sector, which is heavily weighted by the cyclical healthcare, and the small cap stocks actually outperform the mega cap technology stocks over here. Okay, but later I'll share with you on the short-term intraday technical outlook, what are the key levels to look out for on the Nasdaq and the Dow Jones Industrial Average as we go into this segment. And another particular event that I'll share with you, or data that took shape on last Saturday, is the key economic data from China that continue to show an increasing risk of a deflationary spiral. Housing price index. Why housing price index is important? Because close to, I think, about what, two-thirds of Chinese economic wealth is being tied to the housing prices. And over the last 10 years, there is a lot of wealth management products that also tie up to the China property, the China property developer stocks, and they are interrelated dynamics as well. So if housing prices continues to tumble, indirectly and directly, it will have a dampening consumer sentiment impact on China, which eventually lead to a slowdown in China retail sales, which has played out as well. So housing price index continues to tumble for, I think, 14 consecutive months of decline, down negative 5.3% from negative 4.9% that was printed in July previously. So if you look at the trend of the housing price index in China, that's composed to new home prices of the biggest 70 cities in China, that means it's down by 5.3% year on year, and it's a 14 consecutive straight month of decrease, and it's the steepest pace since May 2014. If you look at the 5-year trend, all right, over here. No, in fact, the 10-year trend, that, okay, May 2015 was at 6.1, so it's now the lowest since May 2015. That's close to what, more than about a decade years ago. So it seems to us that there is still no silver lining of any price stabilization of this persistent downtrend in China home price index, which eventually sees a very drastic reduction or underperformance of retail sales. So China retail sales year on year in August continues to expand at a slower pace of 2.1%, below 2.7% that was printed in July, and way below consensus of 2.5%. And even the external sector of the Chinese economy, that means that's depending on exports, which is related to industrial production, because in order to export out of China, China got to do industrial production, and this industrial production starts to decline as well, so indicating that external demand also starts to slow down as well. And more importantly, external demand is one of the only pillar in China that is managed to see positive growth so far, but this source of growth has starts to dwindle down as well. What we could see is it declined. Market is expecting to decline slightly to 4.8%, but it declined more than what is market expecting. Okay, not decline. It grew smaller than what market is expecting, because market is expecting a slight slowdown in growth from 5.1% in July to 4.8%, but it came down below market is expecting at 4.5%. So if you look at the trend of the industrial production, okay, over at the last 4 months or so, since April high of April growth of 6.7%, its growth has slowly start to decelerate. All right, May 5.6%, June 5.3%, July 5.1%, and now it's 4.5%. And this 4.5% over here, 4.5%, yeah, 4.5% over here is actually the softest expansion since March this year. Okay, so indicating to us there's indeed an increased risk of a deceleration spiral that is taking shape in China. And very interestingly, way before this release of this China industrial production data, as well as retail sales and housing price index on Saturday morning Singapore time, on late Friday, PBOC, China Central Bank, actually issued this statement over here. Okay, he said that it will step up its fight against deflation and prepare additional policies to revive the economy. And what's this particular statement over here? This is translated in English. We will make maintaining price stability and pushing for mild rebound in prices an important consideration for monetary policy. That means maintaining price stability indirectly is acknowledging the risk of a deflation spiral in China and pushing a mild rebound in prices. That means, i.e., it tends to increase, give out a kind of a forward guidance that it may start to push out for more monetary policy easing measure going forward. So if that's the case over here, in the very short term, we may see a bit of short-term rebound going into the China stock indices, i.e. its proxy, the Hang Seng indices. But from a longer term perspective, can it totally eradicate the deflationary trend in China? Unfortunately, the answer is no. Why? Because in order to see deflationary spiral being defeated in China, we need to have expansionary monetary policy continue coupled together with expansionary fiscal policy as well, which is lagging right now in the Chinese economy, because the Chinese government, the top policymaker, is still refusing to implement very, very aggressive fiscal policy to kickstart or to improve consumer spending, but like giving out direct, we call it subsidies to encourage more China consumption. All right, that's not taking shape right now in China, unfortunately. All right, so that is the key data that I want to share with you all. All right, so now let us now take a look at the fundamentals and the intermarket dynamics from a multi-week perspective on one particular asset classes, which is particularly related to the Aussie dollar. Okay, before we jump to the Aussie dollar, this is the key data across, put it in a particular chart that y'all can see. All right, so what we see over here is very clearly the consumer inflation, factory gate prices, retail sales are all declining in lockstep together. All right, China core consumer inflation for August grew much lower than compared to the 3 months, only positive 0.3% year on year in August. And you look at this trend is slowly slipping down since February this year. Very similar for the China PPI, which is factory gate prices, producer prices, has a kind of leading impact on core consumer inflation as well. So if this particular trend continues to decline, you see that it actually decline first, then thereafter consumer inflation price continues to go down. And previously we start to see it, the decline starts to subside since June last year. But what's interesting over here is in August this year, the price starts to inch back downwards again from previously it was in negative 0.8% year on year in July. Now it's slipped lower to negative 8% year on year in August. So it seems to us that the previous last 6 months of lesser deceleration on PPI has starts to be eradicated, and price deceleration may resume again. And retail sales that I shared with you all earlier on, which is grew lower than expected at 2.1% year on year, and very clearly since November last year, retail sales growth has started to decelerate on the downside as well, and this is being shown by a persistent downtrend in the 10-year sovereign bond yield of China, so indicating lackluster inflationary growth and lackluster economic growth, i.e. net. So given this lackluster economic growth in China, we has been pretty much depicted over here by looking in at the iron ore prices. So iron ore prices, futures prices, taking into account of the futures, one of the future instruments listed on the SGX. So what I did, I plotted the perpetual futures contract. We know that futures contract expired simultaneously. So a perpetual futures contract allow us to link up previous expired futures contract of this iron ore CFR futures listed on the Singapore Exchange, so we're able to see past trend. And if you look at the trend of the Aussie dollar and the iron ore CFR China's futures contract, they actually move in lockstep since the pandemic March 2020 low. Right, they actually move in very clear lockstep over here. And previously, the Aussie dollar tend to actually move against this lockstep correlation with the iron ore futures was in mid-August this year. So we see the Aussie dollar slightly outperform, but right now it's trying to actually cover the gap over here, okay, where Aussie prices starts to push up, and recently it starts to come down since hitting a high of 19th of August over here. It's trying to come back down to cover the gap. Okay, so eventually what we see over here is that there's no rebound so far that's been seen on the iron ore CFR China futures prices, and it continues to be rather sluggish. And right after the release of the key China data on last Friday as well, and last Saturday, and as well as the China PBOC forward guidance that it will now likely implement more aggressive monetary easing measure, but that doesn't pick up by the iron ore futures prices. Why? Because like I mentioned earlier, in order to deflate deflationary spiral in China, we need to have aggressive fiscal policy together with easing monetary policy, and the fiscal side of the story is not yet shown in the Chinese economy yet. So that's why it actually tells us a rather lackluster iron ore futures pricing. And if you look at the trend of the iron ore futures pricing, it continues to trade below the 50-day moving average. No clear signs of a bearish exhaustion, and the support level to watch out for will be the major one at 78.70. That means IE market is likely to test this 78.70 first before any signs of stabilization, so indicating future potential downside on the iron ore CFR China futures prices going forward on a multi-week perspective that could cap further potential strength on the Aussie dollar from a multi-week perspective as well. Okay, so this is the today's intermarket dynamics I want to share with you all that is pertaining to the Aussie dollar in relationship with the iron ore futures pricing, taking into account of the current state of the economic condition in China that is showing higher risk of a deflationary risk spiral environment or scenario. All right, so with that, now let us now jump straight into our intraday technical outlook on the various cross asset classes. Okay, so with that, let me expand my screen so that you guys could have a better view of the key levels and trend that I'm going to highlight to you all in a few seconds. Okay, so now let us start with the FX market over here. Okay, starting with the euro dollar. Okay, so if you recall, on last Friday we do have a bullish bias on the euro dollar, so still no change. Price action continues to actually rebound higher in today's Asia session. Now looking to retest the 20-day moving average, acting as a first intermediate resistance at 110.89. So the first support level to watch will be perhaps today's Asia session low over here, okay, which is at 110.73, today's Asia session low, but I don't put it so tight as my short-term pivotal support level. I'll still use last Friday pivotal support level at 110.50, which is very clearly the former minus swing high of 10th of September and 11th of September now turns into a pullback support after a clear bullish breakout of it. And in terms of Fibo retracement support, taking into account of the current push up from 11th of September all the way up to last Friday's swing high, it's the 50% Fibo retracement as well. All right, so using 110.50 as my short-term pivotal support, if prices slide and didn't surpass below 110.50 level, we still maintain our short-term intraday bullish bias on the euro dollar. A push up above 110.89 is already pushing up right now. Next near-term resistance level to watch will be 111.40. A breakout above 111.40 may revisit the 23rd of August minus swing high area at 112 figure level. Only an hourly close below 110.50 today. With an hourly close below it, a breakdown below 110.50 will invalidate today's intraday bullish bias to see another round of minor corrective decline scenario unfolding towards the next near-term support level at 110 figure level. A breakdown below it exposes 109.50 next, okay, which is the minor congestion area of 6th of August and 15th of August. That's for the euro dollar. Now moving on, next will be the sterling dollar. Same impact as well. The sterling dollar continues to actually help right above the 20-day moving average, tested and rebounded off in today's Asia session as well after last Friday pullback of it during the later part of the US session. So no change. Today I'll be using a slightly tightened key short-term pivotal support level at 131 figure level, all right, which is also conversing very closely to the 20-day moving average, slightly below it. As long as this 131 figure short-term pivotal support holds, we will maintain this intraday bullish bias on the sterling dollar. First near-term resistance level to watch 132.20. Above it may see a retest on 28th of August swing high area at 132.65. Only a hourly close and a breakdown below this tightened key short-term pivotal support at 131 figure level will invalidate today's intraday bullish bias on the sterling dollar to revisit the minor swing low area of last Wednesday at 130.40/130.10. A breakdown below it may expose or kickstart a minor corrective decline scenario to test close to the 50-day moving average, acting very closely to the next near-term graphical support level at 139.40 next. Okay, so that's for the sterling dollar. Moving on will be our Asia Pacific currency against the dollar, starting with the Aussie dollar first. The Aussie dollar continues to push up in our expectation, but right now it's coming pretty much close to the resistance that we highlighted, and as well as the 20-day moving average as well, that is acting as intermediate resistance at 67.30. So using 67.60 over here, so 67.60 was that resistance level that we look out for on last Friday bullish bias. So we will flip now to a short-term intraday bearish bias using any push-up that is coming close to 67.60. So as long as this push-up didn't surpass 67.60 over here, we will flip to a intraday bearish bias when it comes close to 67.60. First near-term support level to watch out for will be at 66.90/66.70, which is also the 50-day moving average, acting as a support level as well for today. Only a breakdown below 67.70 may expose the next near-term support level at 66.40/66.20, which is the minor swing low of last Wednesday and close to the 20-day, 200-day moving average as well. Only a further push up above 67.60 will invalidate today's intraday bearish bias to see the continuation of this rebound scenario, we call it short-term rebound scenario taking hold to expose the next near-term resistance level at 67.95, followed by 68.20 next. So that's for the Aussie dollar. Right now, the dollar yen. So the dollar yen continues to push down as expected, and now it's breaking down our short-term support, our first short-term support level that we highlighted on Friday, which is 140.25. And using last Friday swing high here as my minor swing, as my first resistance level, 11440. In any case of a bounce, okay, over here. So because since it's now has a decisive close below 140.25, I don't want to tighten it to 14140 to make it so tight. So I will use 142 figure level as my short-term pivotal resistance for today, a tightened one from last Friday, 143. And this 142 figure level, if you take into account of the previous sell-off from last Thursday all the way to today's intraday low in Asia session, it also correspond close to the golden ratio of 61.8%. Okay, so in any bounce over here, as long as this bounce didn't surpass 142 figure tighten short-term pivotal support level that we have on the dollar yen, we will still maintain a intraday bearish bias on the dollar yen, with the next support level coming in at 139 figure level, 1/138.75 level, and a breakdown below this level may expose 137.25 next. All right, so if we go to the daily chart over here, okay, the next level will be this level here. Okay, 137.25. 65/25. Okay, so it's a zone now, taking into account of this Fibo extension level as well. Okay, of 1.618. Okay, taken from this level here. Okay, 1.618. Okay, so now let me go back to the hourly chart to tidy up everything so that you guys could have a better view of it. Okay, so this is the Fibo extension of 1.618, taken from the high of 16th of August, push it down to the low of 26th of August, project it to the minor swing high of 3rd of September. That's the 1.68 level, 136.65, slightly above the graphical swing low of 137.25. All right, so it's a zone, put it as a zone. So just to repeat everything, still maintain that short-term intraday bearish bias on the dollar yen, but today we'll use a tightened key short-term pivotal resistance, pardon me, at 142 figure level. A breakdown, a clear now is breaking down below 140.25. Next support level to watch out for 139 figure / 138.75. A breakdown below this level exposes 137.65/25. Only an hourly close above 142 figure level will invalidate today's intraday bearish bias on the dollar yen to kickstart another round of mean reversion rebound to expose the next near-term resistance zone at 143 figure / 143.70. We also correspond to the downward sloping 20-day moving average, acting as a resistance level as well. Okay, that's for the dollar yen. Okay, that also sum up the intraday technical outlook on the major FX dollar pair. Okay, now with that, let us now move on to the major stock indices, starting with the Hong Kong 33. So I did mention over here is that due to this potential positive feedback loop that could take shape in terms of at least some kind of intraday rebound due to that dovish guidance from the China Central Bank, we did indeed see a bounce of the key 200-day moving average in today's Asia session on the Hong Kong 33, i.e. the Hang Seng Index. And still recall this bounce off here at 17,140. So this 17,140 was our last Friday bearish bias support level to watch. So the support level has really indeed been met, very close to this 17,140. Given today's intraday session low is at 17,171 so far, that's been seen on the Hong Kong 33. And given the bounce off this key support level, which will correspond to the 200-day moving average, so this will be our key short-term pivotal support level for today on the Hong Kong 33, and we will flip to a intraday bullish bias on the Hong Kong 33 using 17,140 as my short-term pivotal support level. Now it's actually breaking above the first intermediate resistance at 17,330. Above this level exposes the 20-day moving average that is acting as a resistance, and as well as the 50% Fibo retracement of that previous sell-off from 30th of August to 11th of September, acting as a resistance zone at 17,595. So we are looking for the next resistance zone to come in after 17,330 will be at 17,500 / 17,595. Only a breakdown with an hourly close below 17,140 will invalidate today's bullish bias on the Hong Kong 33 to see the continuation of this impulsive down move on the Hong Kong 33 index to expose the next near-term support level at 16,960, followed by 16,840 next in the first step. So that's for the Hong Kong 33. Now, with that, the Japan 225 continues to remain sluggish as it continues to test our first support level that we have on last Friday, where we flipped to a intraday bearish bias. So still no change given the lackluster movement of the hourly RSI that continued to shape lower high and now inching back below the 50 level mark, inducing some form of intraday bearish momentum that is still in play on the Japan 225, i.e. the Nikkei 225. Still no change, maintain our intraday bearish bias on the Japan 225 using 37,170 as our short-term pivotal resistance. A breakdown below 36,195 will expose the next near-term support zone in first step at 35,400/35,115. Only an hourly close and a breakout above 37,170 short-term pivotal resistance will invalidate today's intraday bullish bias on the Japan 225 to see the extension of the minor recovery scenario or mean reversion rebound scenario taking shape again to expose the next intermediate resistance at 37,570/37,880, which confluence with the 200-day moving average and the 50-day moving average, I think as a similar graphical same resistance zone as well. That's the Japan 225. Now moving on will be the European stock indices, the German 30. So the German 30 last Friday broke above our short-term pivotal resistance level that we have at around this 18,670, which is also the 20-day moving average. So very clearly it's actually continue this ongoing rebound that has taken shape so far since last Tuesday, 10th of September low. So given the push up of this price action, we got to respect the current positive intraday momentum that has taken shape in the German 30 index. So with that, using last Friday short-term pivotal resistance level now turns into a short-term pivotal support level. So any potential dip right now that managed to hold above the 18,660 short-term pivotal support level that we have for now, we will flip to a intraday bullish bias on the German 30. First resistance level to watch will be 18,820. Break up above this level re-exposes the current all-time high area at 18,970. Only an hourly close below 18,660 will invalidate today's intraday bullish bias to see the continuation of another round of short-term weakness coming back into the German 30 index to retest 18,390. A breakdown below 18,390 exposes 18,160 next in terms of the intraday bias or intraday levels, I would say. So that's for the German 30. Now, flipping our attention now to the US Wall Street 30. So the US Wall Street 30, which is the Dow Jones Industrial Average, continues to burst up above our neutrality range that we highlighted at around the 41,200 level. It burst up and hit our first resistance level. Next resistance level at 41,535 before trading sideways. So right now I could see over here is that there is no clear signs of a bullish exhaustion. Why? Because price action on the RSI, yes, it hit the overbought level. Upon hitting the overbought level, there is no signs of a bearish divergence. That means price action continues to shape higher high over here. It just only dip back down into the back below the overbought region. All right. So indicating to us that there is maybe potential some signs of a pullback close to the first support level that we highlighted over. That could be this level here, which is last Friday low at around the 200-day moving average, 20-day moving average as well at 41,300. So using a slightly lower level at 40,990, which is this very clear graphical former minor swing high that was tested on 6th of September, 10th of September, 12th of September, and finally it broke out on the last Friday. So this will be indeed a very clear former minor swing high that was previously tested in 4 times, that shape that bullish breakout now turns into a pullback support level, which is so close to the 20-day moving average as well, that is acting as a support level. So as long as the potential pullback didn't fall below 40,990, that means it didn't dip down below this 40,990 short-term pivotal support level. We will flip to a intraday bullish bias on the US Wall Street 30 after 41,535. Potentially, it will actually see the next resistance coming in at 41,810 / 41,950 level. All right, so right now we will flip to a intraday bullish bias on the US Wall Street 30 index for now. All right, so as long as this level holds 40,990, so if price action starts to break down below 40,990, we will actually invalidate this intraday bullish bias to expose the next near-term support level at 40,620, followed by 40,140 next. All right, so that's for the US Wall Street 30. Now, coming into the next index will be the US Nasdaq 100. So one thing I want to highlight over here is that the US Nasdaq 100, last Friday we were neutral between 19,630 and 19,320. But what's interesting over here is that the configuration of the momentum indicator on the hourly RSI is different from the hourly RSI on the US Wall Street 30. Why do I say so? If you look at the momentum over here, it starts to shape a lower high instead, okay, on the Nasdaq 100. Okay, so indicating to us there is signs of a bullish exhaustion by this bearish divergence that is being displayed on the hourly RSI before it slipped down back below its overbought region, right over here on last Friday. So indicating that potentially there could be some signs of a much more deeper pullback coming into play on the we call it Nasdaq 100, given this potential bullish divergence that's been seen on the hourly RSI, indicating some signs of a short-term bullish exhaustion in last Friday rebound, okay, in price action, indicating a much more deeper corrective pullback, at least on an intraday basis in the first step. So with that, we will use last Friday upper boundary of a neutrality range. We will now put it as a short-term pivotal resistance for today, 19,630. So that will be my short-term pivotal resistance on the Nasdaq 100. Flip to a intraday bearish bias on the Nasdaq 100. First near-term support level to watch will be at 19,320. A breakdown below it may expose 19,090 and even 18,900 next. Only an hourly close with a breakout above 19,630 will invalidate today's intraday bearish bias to see the continuation of the rebound to expose the next near-term resistance level coming in at 19,900 next, which is the minor swing high that previously was resisted since 23rd of July and 24th of July this year. Okay, so that's for the Nasdaq 100. And also sum up the intraday technical outlook on the major stock indices across the globe. So now with that, let us now take a look at the commodities market, starting with the gold XAU/USD. So gold XAU/USD continues to push up and hit our first resistance level at 2,588/595 that we highlighted on last Friday. There's no very deep pullback over here, only very shallow price push down in price action. So what we could see over here is that the RSI has now indeed go back to the still in the overbought region over here. Okay, what is the overbought region? So previously over here, there is no clear signs of a bearish divergence as price action continues to shape a higher high. Okay, previously over here. Okay, higher high, and after that, oops, where was I? Okay, so after that, the price pullback. So and this pullback takes shape into last Friday, later part of the US session, and today's Asia session, it bounces off again over here at this point in time. So what I do over here is that I will use, so what we can say over here is that is potentially the first support level to watch now, okay, will be this level here at 2,570. So, and what we could do over here is I'll do the Fibo retracement of this very strong rally taken off the low of Wednesday all the way up to today's current Asia session. the 50% FIBO retracement, at least the middle part of it, okay, of this rally is at 2,545. Okay, so as long as this minor pullback didn't actually fall below this 2,535/2,545 Titan short-term pivotal support level that I have on gold XAU/USD, we will still maintain that short-term intraday bullish bias on gold. Next resistance level to watch in the near term will be at 2,600/2,606, followed by 2,615 level, which is a FIBO extension level. Okay, if I take into this sub rally from 9th of September high, push it up to 11th of September high, then push it up from the intraday low over here on last Friday, is give us around 2011 over here. Okay, push it out here, 2015. 2,615, pardon me. All right, so just to recap, as long as any minor pullback didn't surpass below 2,535/2,545, we will still maintain that intraday bullish bias on gold XAU/USD. Next near-term resistance level to watch, 2,600/2,606, followed by 2,615. Only an hourly close below 2,545 will negate today's intraday bullish bias to kickstart a much more deeper minor corrective pullback scenario to retest the prior 4-week range resistance over here that was in place on 20th of August, now turned into a key pullback support zone at 2,532/2,526 level. Okay, so that's for gold XAU/USD. Now, lastly will be the West Texas crude oil. So West Texas crude oil on last Friday, we have that minor intraday bullish bias scenario to play this mean reversion rebound. Looking for the first two resistance to look out for will be at the 71.15, followed by the 72.20/73.15, which is formerly the minor the symmetrical range resistance over here. Let me put it in daily. The symmetrical range resistance over here, yeah, the symmetrical triangle range resistance support, the symmetrical triangle range support level formerly from 13th of December 2023 low now turns into a pullback resistance at 72.20/73.15, which is also confluence with the 20-day moving average, acting as a similar resistance zone as well. So still no change, still using that 68/67.50 as my short-term pivotal support on the West Texas crude oil to maintain that intraday bullish bias for this mean reversion rebound to play out. Resistance level remains the same, 71.15, followed by 72.20/73.15. Only hourly close below 76.15 level will invalidate today's intraday bullish bias to see the continuation of the impulsive down move in first step to expose the next short-term support zone to watch out for, or near-term support zone to watch out for at 65.94, followed by 65.10. All right, so that's the outlook, short-term technical outlook on West Texas crude oil, and also sum up the intraday technical outlook of the major cross asset classes. So now before we go, let's take a look at the economic calendar. What are the data to look out for today? Okay, so for today will be a rather quiet day in terms of economic data release, even in Eurozone as well. So Eurozone, one particular event to look out for will be a ECB official Lane speech. His name is Lane, L-A-N-E, at 8 p.m. Singapore time. US session will be not much of a high level economic data release. And in tomorrow Asia session as well, in the early morning, there's nothing to look out for as well. So that sums up today's daily dose of market insights for today. So with that, I'm Kelvin here signing off, and we shall speak again tomorrow. Thank you.